Good morning. Welcome to Bazaar Morning Call. That will be the most important cue that we are going to perhaps dance to. The Federal Reserve cutting the growth forecast for 2019, cutting the number of rate hikes from 3 to 2 according to their dot chart, but hiking rates for the moment. Markets are sulking because they expected, as Bob Pisani said, total capitulation from the Fed, that it would go completely dovish. Well, it's gone thoughtfully dovish, and that's not enough for the markets at this point in time. We're seeing deep red across Wall Street and across Asia as well. But India has stood out. India has stood out largely because there's a huge movement in yields downward. It was the Reserve Bank's giant injection of liquidity, and yesterday the 10-year yield almost stood at 7.2. This is in response, of course, to the increase in liquidity by the Reserve Bank, as well as crude prices going to $56. The question we need to ask now is, should Indian markets rise even more? This has been a giant rally from 10,300 just on December 7th, was it, when the numbers, sorry, December 11th, when the state government results were announced. And where are we standing at December 20th? Have we taken in all the good news of a seminal fall in interest rates to 7.2 and a fall in crude rates, or do we have legs to ride more? My own sense is a bit of consolidation will be good for the bulls, but we'll have to wait and see. Good morning, Sonia.
Hi, Lata. Good morning. Yes, after a 600-point rally that we've seen from the December 11th level, I mean, some amount of profit-taking perhaps is on the cards. But, you know, I think the biggest takeaway is what you pointed out, the slowdown in growth, right? The Fed talking about the US growth, cutting it down, the estimates to 2.3% from 2.5% for 2019. And the one thing that the market just doesn't like is the word uncertainty. And Jerome Powell used those words. He said that there's a fairly high degree of uncertainty as far as, future growth is concerned. I think that's something that spooked the street, and that's why the SGX Nifty as well is down. But even domestic institutions sold yesterday in our market. So I guess before the end of the year, before people go on leave, it may not be a bad thing to just take some money home.
Well, that may be one reason why people are taking money off the table, but it could also be that the market has not completely factored in the impact on India if there is a global slowdown. Yeah. We tend to think that we are less connected with the world, and therefore both tariff wars and global slowdown and global growth, India becomes kind of a low beta play at such times. But I can tell you that repeatedly, whether it was the upcycle in 2003 to 2008, the down cycle from 2008, and again the recovery. India has very much been a part of the global economy. It is underappreciated. It may be less than perhaps China, Taiwan, Korea, Singapore, which are complete plugs into the global economy. But the global slowdown, and if it's a 1%, one rate hike less, and about a 20 basis point cut in US growth that the Fed is forecasting. And if that is part of the reason why you're seeing such a steep fall in crude prices as well, because global growth will slow down, then I think we are underappreciating our linkages to the global economy. A large part of even Sensex and Nifty earnings are dependent on global markets. I mean, from all the Reliances, the Tata Motors, the Bajaj Autos, all the tech companies, they are all globally dependent. And to say that, we are less affected by the slowdown, we have to genuinely ask ourselves how much less. And therefore, maybe this would be a time to pause. We have had a 600-point rally. And I think much of that rally was because we thought we're going to get a fiscal and monetary stimulus. We have got a monetary stimulus, but I think we are running away with too much by way of fiscal stimulus.
Absolutely. And, some more of those comments are a bit worrying, right? When you say that the trade war is going to impact employment and hiring, I mean, that is something, at the end of the day, it all boils down to jobs. So not just a growth slowdown, but even lesser amount of jobs is something that is definitely spooking the street. But let's see how, we move from here. So far, the MSCI India index in this month is down just about 1%, a little over 1%, while the MSCI Asia ex-Japan, MSCI Emerging Market Index are all down about 3-4%, and the S&P 500 is down about 6.5%. So we've seen a fair degree of outperformance. Let's see if that continues. Let's also take a look at what our wise experts have to say as we head into trade this morning. Chris Wood of CLSA says, amidst the massive media noise about the course of rate hikes and the dot plots, there remains remarkably little discussion about balance sheet reduction. Yet he says the market suggests that the impact of quantitative tightening is now really beginning to kick in, which is not so surprising with the Fed balance sheet having already shrunk by $383 billion since the commencement of the asset reduction plan in October 2017, and on course under the current schedule to shrink another $50 billion a month. Meanwhile, on a global basis, Chris says the G7 central bank balance sheets have stopped expanding in the US dollar terms since the month of April.
Well, actually, that's what spooked the market most. Jerome Powell saying he's satisfied with the balance sheet contraction program. He lowered only the number of rate hikes, not he. The dot chart only lowered the number of rate hikes, but it did nothing to the Fed's tightening program or quantitative easing getting unwound. And that has been another bone of contention for the markets. Let's get you money market views. They will be important today on the backdrop of the Fed. Mohan Shenoy of Kotak Mahindra Bank says the US Fed rate hike was as expected. However, Fed statement that neutral rate is still some distance away indicates 2 more hikes in 2019. Resultantly, he says the dollar recouped its recent losses and US equities gave up gains. He says crude oil prices continue to remain weak, with Brent trading well below $60 per barrel, which is rupee positive. Mohan says currency markets are winding down ahead of the year-end holidays, expects the USD-INR pair to trade in a range of 70.50, 70.80 for the day. So a little weakness expected on the rupee.
Okay, and he also talks about the bond market. He says the announcement of open market operation purchases by the RBI for January, lower crude oil prices and appreciating rupee has turned the bond market bullish. However, profit booking could halt further gains. He expects the 10-year benchmark bond yield to trade in a range of 7.23 to 7.28% for the trading day.